All right, my friends. So I just posted this earlier today on my on the community section of my blog of the YouTube channel. Do you know the 10-year Treasury is still trading at 2.68? 10-year Treasury, 2.68. So let's say you have cash on the side. You're like, man, what do I do with this cash? Because my man Graham Stephan, whatever his name is, he talked about at a video today or the other day. If inflation, the target inflation is at 2%, which it is. That means inherently you need at least 2% a year just to break even. But you need more than that because your cash, you have to pay tax on that. So let's just say when all said and done, you need 2.5% just to break even on your short-term money. Well, what would be wrong with going and buying a 10-year Treasury bond? Maybe not the bond explicitly, but let's just say the Vanguard Intermediate Bond Fund. What would be wrong with that? The Fed has already raised rates. They already have. Last year, they raised 5 times. And again, the Fed raising rates doesn't have much impact on intermediate and long-term bonds rates. In fact, I'd argue has hardly any impact on it whatsoever. Now, it does have impact on short-term. We all get that for sure. So CDs look better now. But given that the damage is done, if there were any damage, and frankly, off the top of my head, I don't know. I imagine the bonds didn't do great last year. But look historically, man. When the bond market goes down, the next year the bond market goes up. Does that mean it's a guarantee? No, nothing I say is ever guaranteed because I don't know. Hell, I could get hit by the Amazon truck that just drove by me, and then it's all for naught. But what I'm saying is, if I got some money and I'm like, man, I don't know what to do, why not buy an intermediate bond fund, a government intermediate bond fund? You know you're going to get, I don't know, 3%, something, not probably 2.5%. The bonds that are guaranteed by the feds, I mean, they're not going bankrupt. On any given year, you might lose money. But, I mean, the facts are that ship has sailed for what interest rates have done. I mean, interest rates, they raised them, again, 5 times last year, man. 5 times. So if you got cash on the side, you're worried about the stocks because the price earnings ratios are high or whatever it is. And look, I get it. I am not a believer in extraordinary stock market returns for the next 10 years. If you watch my video, my channel at all, you know that. And I fall in the Vanguard mold, which is about 7-8% nominal. You factor in a 3% inflation, that's 4 to 5% real return, and you still got to pay tax on that at some point. So you factor another 1% tax, you're getting, what's that, 3 or 4% real return, real return. Like Thorndike used to do this thing called real returns, where they looked at taxes and inflation in terms of your overall portfolio. It's a wonderful chart. Maybe one day I'll do another video on that because I've never done one on that because it's a wonderful chart. But anyway, if I'm sitting there saying, look, I don't want a whole lot of risk. I'm getting clobbered at the bank because inflation's eating me alive, and I want to get more than a 10-year Treasury bond. I want to get more than a 6-month CD or a savings account. Why not buy the Vanguard 10-year Treasury, intermediate government bond fund? I literally have no idea what the yield is, but it seems to me a lot of the risk is behind us from last year. It already happened, and I don't know. I mean, the minute you buy it, it's probably going to lose all its value. But at least you know for a fact it's guaranteed, and you'll won't lose your money because the bonds will be mature and they'll pay you. So something to think about, my friends. If I had some cash on the side, I might be thinking that way. And if I was a little bit what's the word I'm looking for? Risk adverse, that might be someplace I look. All right, we'll see you guys next time.